Welcome back. And this is, of course, the final panel discussion of FIMMAC 2021. It's been a very long and interesting journey since Monday. But of course, we shall cap this with a very interesting topic, which is called loan financing. And in this panel, we'll be basically answering three big questions. The perks of financing your investment, i.e. borrowing to invest. The second is, of course, understanding the kind of risks that you will take if you do take on personal loans for investments. And finally, how do we move forward in terms of allocating proper planning, financial planning, to manage not only these risks, but to grow your investments in the long run. In this panel, I have an all-ladies panel, which is fantastic. Linnet Lee, the CEO of FPAM, joining us. Nirmala Subramaniam of AKPK, or Agency Counseling and Pengurusan Credit, as well as Joyce Chuah, the CEO of Success Concepts Life Planners. Maybe we can start with Nirmala, because some of the big debates right now is on not about loan financing, but debt management outright. It doesn't matter what you take the liabilities for. If you can't service it, game over. And a lot of people actually turn up at AKPK to help resolve their liability issues. And of course, this is not necessarily a good thing. The fact that they're asking for help is actually quite crucial. But perhaps you can share with us some of your experiences when it comes to your work in AKPK and how debt management has become a big problem for the country. And perhaps we have to really think hard about taking up more loans, even if it's for investment. Nirmala.
Hi. Good morning. Thank you, Ibrahim. Thank you for the question. Thank you for the opportunity here today. Good morning, everybody. All right. Well, it's a big question. You're talking on Friday about loan, and but when it comes to loan, there are two kinds of loans that we always look at. One is a productive loan, and one is a non-productive loan. When you take up a loan in order to generate an income, we call it a productive loan. In terms that you take up a loan where you're investing in a property, so the asset the price goes up, the value goes up. So that's like you're gaining something out of it. So that's considered a productive loan that we're looking at here. And that's why we talk about good loans. And then when we talk about unproductive loans, these are more of loans that cater your lifestyle, where you actually want to cater your lifestyle. So this is something that we really have to look at prior to taking up a loan. So mostly when we take up a loan for investments, they're considered good loans because you are actually using up these funds to generate more income that would actually help us. But we also have to be very careful in terms of what kind of investments are we going to go into, so we've got to weigh that, what are the pros, what are the cons there, how stable it is, because there is a cost here that you're going to pay. When you take up a loan, there is a cost. So this is what I see in AKPK when they came up with all the miscalculated risk there. They did not really understand the investment that they are getting themselves into. That's, I think, the key factor. Because if you're like, you see everybody, hey, I'm making money here, so you get like really hyped up. I also want to make money. I don't want to miss the boat, and things like that. But what happens is you don't have the money. So of course you want to go for financing, right, to invest. So if you really do not understand the investment and what's the risk, what's the possible thing there, you're just like on the herd mentality, you're just following the crowd, then that is a danger. That is a danger. So we're not going to say that all loans for this is bad or this, but it's all about you knowing what are you taking this loan for, the purpose of it. You must understand, the purpose of that investment. You must also know your payment ability, whether you can really afford to pay or not back this loan if something happens, So this is where I know I've seen cases where they invested in big schemes. They wanted fast money, and sometimes it's so wrong. I had a guy who went into Forex, and he used up his credit cards up to 100 over 1,000, because initially you're making money. But here's something that you got into, what you call this, you got greedy. You got greedy and you wanted to earn more. So that's where it came to going up and just accumulating your debts. And you forgot to know that credit card debts are very, very high cost debts. So you really got to weigh these two. So I've seen cases. So this is like knowing whether I can really pay back or not. The payment ability should be there also, you know. So that's something that we always look at. What are the 3 P's before I want to borrow? Is I need to have the purpose. I need to know the purpose. I need to know my payment abilities, and I also need to maintain a good payment record. So whatever loans that I've taken, you know, is within my capacity, and it's also I have good records maintained for that. So that's very important. So there are many types of financing loan. I mean, if you want to finance investment, like maybe properties, that's very common, and then very commonly known is the ASB and all these loans that you know. Then there's also shares that you can actually finance. So you got to weigh also whether the risk, you know, so this is what we see. They don't know the risk, whether the higher, of course, higher the risk, the higher the return, but you know, you got yourself with a loan, there's a cost to pay, and you still have to pay this loan no matter what happens there, you know. So we have seen also cases where they've invested in wrong businesses. This is called, like, I've seen cases where they invest in leech breeding. You know, leech breeding. They've invested in, there was this pokok haru, you know, it was meant for medical purpose, you know, so it's huge amount that they took financing to actually invest in these schemes where they were promised really, really high returns. So, and it all went wrong. So they had to come to us because the loans still have to be paid, right? And that's where we saw many issues in terms of affordability there. So it's good that we are on the mindset of, you know, I want to invest, I want to grow my wealth, you know, that's the only way. But we also should be very careful when it's coming to, there is a cost to it. Of course, everything there's a cost to it, but we should also be very mindful when it comes to loans. So don't overtake it.
One of the big problems that we think about is that when it comes to loan financing, it's mostly ASB financing, but there's so much more, as you were mentioning just now, Nirmala, on the issue of investing in agricultural activities. One investment I've heard of is vanilla. My Grab driver ended up having to be a Grab driver because he was taking up so much loan to invest in vanilla plants. That didn't work out so well for him. That just went out of the window. Of course, there will be some technical questions like, for instance, should we take up ASB loans or any other loans? But perhaps we'll take a pause for Nirmala and perhaps toss this question to Joyce. Joyce, I think we have to ask ourselves or continue to forward that idea of good debts and bad debts. Nirmala touched about productive loans being financial liability taken up to further the wealth of the individual. But there's also that element of good financial planning. Maybe you can elaborate on good debts and bad debts, and perhaps how does this fit into the financial planning angle, Joyce?
Yes, good morning, everyone. Thank you, Ibrahim. I definitely agree with Nirmala that there are good debts and bad debts. I often say that not all debts are bad, and debts are like cholesterol. That we have good cholesterol and bad cholesterol. It's a matter of what's the ratio of these. In fact, as far as debts are concerned, you should have zero bad debts altogether. But it does not mean that you should not have any debts, especially if your cash flow is supporting the fact that you're eligible for a good debt, like a mortgage debt, or even a loan for ASB, which I'll touch on maybe a bit later throughout the discussion. Now, the fact is that we are now in a low interest rate environment. And as a financial planner, from a financial planning perspective, a low interest environment stimulates your opportunity to have more wealth, to build more wealth. Now, as far as building wealth is concerned, a good debt puts money into your pocket. A bad debt takes money out of your pocket. So what are some of the good debts? I've mentioned mortgage is really one of the best ways to build wealth because it allows you to, in fact, immediately have an asset or a place to live in if you're using it for your home. It allows you leveraging benefits in other words, yeah. You're looking at mortgages. It builds wealth. It helps you make money while borrowing money. I mean that's That sounds like a nice proposition. You're using other people's money to make money. But then again, as Nimala has mentioned, or yourself, Ibrahim, that making money using borrowed money needs guidance, needs some strategies and careful thoughts. So as far as loan financing for investments are concerned, I really like that proposition, because it adds value, or it adds to your net worth, all right? And it allows you to have that the investment straight away. For example, if it's ASB and you take a loan for 200,000, immediately you have 200,000 in your hand, though it may not be yours yet because you're still repaying the loan. However, it's in your net worth. Of course, you still have a liability against it, but it's being built slowly. And ASB is a very good example, because it does not give you any volatility in that sense, and it gives you a very secure, confident type of investment asset class. So that's a really good example of how you can build wealth. However, before I go on into what are some of the proper planning that you should be looking at, is that with loan financing or getting a loan, it creates liquidity for you, like what's happening in the US, on a bigger scale, on a micro level. It creates liquidity for you, because you don't have to use a whole lump sum to buy a house, and then that particular money can be utilized elsewhere, hopefully prudently. But as I mentioned, it comes with risk, and you have to have proper guidance. And some of the things that you need to start off with is know why. What is your goal of getting the loan? If it's for investments, why? If you're getting a house or a property and you're getting a loan, what is it for? Is it own stay, or is it for rental? And if it's for rental, you need to do some calculations. Also you need to know your DSR, your debt service ratio. Are you able to repay that big loan without getting into trouble? Do you have a buddy or a financial planner or a friend who will just nudge you and say, hey, look, you shouldn't be dipping into this because, for example, ASB, you've got your 200,000, you are not supposed to dip into this. This is meant for the long-term purpose, like retirement or some other lifelong purposes. I think the other one is looking at hidden fees. There are also fees when you get a loan, legal fees, stamp duties, that can be really hefty. Last but not least, I say that if you're looking at getting a loan for investments, please manage your emotions as an investor. Money really makes us very different people when it comes to investments. We may be very calm as a person, but when it comes to our money being on the line and the rubber hits the road, that's when we change. And what type of investor are you? Do you have a guide? Do you have someone who will be able to tell you to stay calm during volatile periods? So those are my thoughts, Ibrahim.
Thank you very much. Timely thoughts, actually, if you think about it, because people don't tend to behave the same way when it comes to their money, and become a little bit more irrational, if you ask me, a little bit more nervous and a little bit more impulse driven. But that's speaking out of experience. Let's now move to Linnet. And of course, I want to talk about more on the risks that the investor must think about when it comes to taking on loan investing. I know a lot of us would probably know what the risks are, but sometimes it's important for us to go through the risks yet again. And of course, it's not just about the risk, it's also the ability for us to continue to service such loans. Maybe Linnet, you can explain or share your ideas on these two items.
Thank you so much, Ibrahim, and to FIMM for the opportunity to share on this topic. I'd like to share my experience, and it started during the days when I was a unit trust consultant myself. And my group agency manager is popularly known as a loan financing queen. So bearing in mind that her clients are business people who are very used to gearing in their business, therefore, when they take a loan to invest, they are very aware of what are the risks involved, and they know what to expect. They go in with their eyes open. However, what about people in the street? So before I introduced to my clients, I decided that I want to try it out for myself. So at that time, I was given a personal loan by then called Filio Allied Bank, now part of Maybank. I did 2 tranches. The first tranche was during a rising market. I used 1/3 of the money from my mortgage and the other 2/3 my own money. And within 3 months, the market went up. And when I did a quick calculation, I was making 3% after netting off my capital, my service charge, and my loan interest. Of course, I didn't take out my commission as a UTC because that time I thought I must behave like an investor. It worked out to averagely about 12% per annum for the total amount that I have invested. I cashed out because this is an experiment and put my capital and my gains back into my mortgage account. The feeling was really, really great. It's a euphoria because you see, I only used 2/3 of my money and I get full return on my investment. Now, 2 months later, as I said, I'm still on the experiment. I decided to experiment again with the same modus operandi, 1/3 and 2/3. This time, the market was going down. So I monitored the investment very closely because I am paying interest on my borrowings. I had to pay attention to what fund managers had to say and economists' views on the market moving forward. Now, when the market looked like it's not going to improve in the short term, and my interest is increasing, the amount of interest that I paid, I decided at some point in time to cut loss and sold my investment. While I may have lost money in the second tranche, but if I take my first tranche and second tranche into consideration, I actually broke even. Now, how do I feel then? The feeling at that time was anxiety and the pain of losing money. By the way, my risk appetite at that time is moderately aggressive, which means I cannot take a lot of risk, just a little bit more than your man in the street, so to speak. So the lesson learned here is do know your risk appetite before you consider such investments. All right. The other lesson learned is awareness that in a rising market, it is all right. But in a down market, you make paper loss for short-term investment. Unit trust with service charges is not a suitable investment for such loan financing or punting, I would say. But having said that, I agree with what Joyce said, that financing can be a tool for someone who wants to create an instant pool of money for a goal, like child education, for example. But it must be bundled with a protection tool, either an insurance or a takaful in the case of unforeseen circumstances. The other thing is that the investor must also budget to pay the installment from their monthly income. So the key points in loan financing is, number one, what is your intention, your niat? Number two, your discipline to pay back. I think yesterday when we had our prelim discussion, we're talking about how people went crazy, seeing so much money, and instead of sticking to what the purpose is, they use the money for something else. Of course, they live to regret it. And number three, I want to touch about something that's more current, and that's taking moratorium to invest. It may not be a good idea if you're expecting to punt the market. If you can afford to pay your installments, better to pay it off, as we do not know what the market holds, especially in these challenging times. New variants are coming out, don't know how the economy is going to be. Markets open, markets close, borders open and borders close. So having said that, my final point is, if this is happy money, you are willing to punt and won't break a sweat in losing all of it, then you can go ahead. But you must be willing to take full responsibility for your loss, as investment gains are not guaranteed. That's one thing. The second thing is, do weigh your what you want to invest, and whatever that the unit trust consultant tells you, you please ask more questions. And if you're unsure, then don't do it. It's better to err on the side of caution, as this is your hard-earned money. Listening to what Nirmala shared earlier, I feel the pain. I feel the pain because I've personally taken someone to AKPK for help because he was in financial difficulty. And it's really a painful process. Don't go there. Learn from other people's mistakes. That's my sharing, Ibrahim. Over to
Thank you very much. But I just want to highlight that going to AKPK is a good idea, particularly if you are in financial distress. It's also important for us to seek help whenever it's needed. I think there shouldn't be any stigma, there shouldn't be any problems of somebody acknowledging that somebody is going to a KPK. It's like, mental health. If you need a psychiatrist, it's good. It's good that you're seeing somebody. Particularly, times are tough right now, and times are uncertain, particularly when many of us may have had job loss or seen our salary cut. So that is the backdrop of stigmatization versus seeking for help. But I also want to highlight one idea, which is, of course, cheap money versus expensive money. Some loans are quite cheap. We're looking at 2%, 3%, and then furthermore so now because of low interest rate. Some, I guess, loans are very, very expensive. Credit cards are the easiest example. Personal loans can go up to 20, 30% sometimes, particularly if you are undiscerning in terms of the bank's offer loans. First, when you talk about 18% credit card charges, if you tally it all up, including the fees and all that, I'm sure somebody like Joyce would probably tell me it's much, much, much more than that, right? And I agree. Right? Yesterday, I had to cancel one credit card, UOB, and they were pestering me not to leave them behind. But unfortunately, some of us may have to part our ways. So it's not easy to just cancel cards, even if you want to. Maybe any of the panelists can take up this question. When do we know how do we tell? How can we tell if the loan needs to be fully paid off as quickly as possible versus the kind of loans that we can let it run, perhaps even until maturity, until the tenure ends, to a point where we can actually use the money for something else. Maybe, I don't know. Anybody wants to take this up?
Well, yeah, I'll just take it up. I've always talked about cost versus benefit. So the cost of your loan is 20, 30%. And what is your benefit? Now, if you're a businessman and you have a business and the business runs successfully and you're getting 40, 50% out of your 20, 30%, that's absolutely fine. Just go ahead and max up your credit cards. But how many of us have this business acumen to be able to run a business and get a high profit margin, especially in the early stages of the business? So it is a cost benefit thing. So it's likewise, I hear a lot of people taking out EPF to clear their mortgage balances. That's also not prudent because EPF provides or rather declares dividend around 5%, and you're paying what, 3%, 3.2 on your mortgage. You're actually out of money. So those are the guidelines that I would be advising clients on. Ibrahim.
Linnet or Nirmala, you want to jump in?
I would totally agree with Joyce on this because you got to weigh in actually, because we've seen a lot of clients, even someone will tell me, okay, when I reach 50, I want to take out my 1/3 of my EPF and settle off my housing loan and mortgage loans and things like that. But this is where we say, wait, what is the reason why you're doing that? Okay, unless you tell me that, oh, I have difficulties on my monthly commitments, I can't make my monthly commitments, I'm really, really running short of cash every month, and due to that, I end up using credit cards for my need and things. Then in that case, you may want to do this because you need that money for your monthly expenses. Here also, you have to be very careful because the moment we have settled one loan and we have extra cash in our hand, we don't think about going and settling all the other loans that high, but we end up like wanting to use that money more for our daily expenses and things like that. So this is something we got to be very careful, because I've seen a lot of people who will opt to refinance their property, to settle up their credit cards, their personal loans and things like that. So because this is where cost, because here is a lower cost, this is a higher cost. So let me refinance this so I have a lower cost so that I can settle up these loans, which is ideally that's how it should be. But the problem is when we settle off these loans, we should really, really settle off these loans and no longer start it back. That means no longer using the credit cards or no longer taking up anything else, because you must remember that you have already increased your mortgage loan here. So there's already an additional cost that you're going to pay. Despite, yes, the rate is low, but still an additional cost. It's still a lot more money, you know. And then when you start accumulating more debt, so then this is where we have this idea of digging new holes to cover up old holes, and you keep digging and digging and digging. It's be a never-ending story, but you don't end up happily ever after. See, so it's something that we should be very careful of in this aspect. So should I do this? Because this is the questions we get. Should I the house lah, especially the house, because you know if the rate that low, and people would try to make out of it. So should I pay it up earlier? Should I refinance to settle up higher expensive loans? So all that is fine, but remember not to start any new debts after that. Do not until you have settled this, because this. But if you are going to EPF to do the withdrawal because you have to reduce your monthly commitment because it's very tight for you, and because of that, so if you're doing that, you really have to ensure that because this is your future money that you're withdrawing from EPF as well, your future earnings, and that's quite high. So you've got to also be careful and make sure you settle off this amount, and make sure whatever additional amount it's really used for your need. If you have assets, invest back. If you have assets, invest back. Don't delay on it. Maybe at times you needed to withdraw the money, but when you have the money, put it back in, because you will not realize it now, but you will realize it when the time comes and when you really need that time when you're not actually earning. So I would tell people, try to make use of the monthly earnings you have. Try to make use of that to settle all this, rather than looking at long-term savings and just wanting to withdraw them out for the current need. So got to actually weigh in a lot of factors here.
Yeah, just adding on to what Nirmala and Joyce has shared. Loan, by the way, is a 4-letter word, and so is love. Okay, so I would say please love yourself and be careful when you take your loan. I still think that loan can be a good investment tool to use, but number one, as Nirmala has shared so many cases, too often people use it for the wrong reason. I remember I had a phone call from the bank offering me credit card, and I told them I already have 3 credit cards. I don't need them anymore. He said, take 1 more. And I said, what do you want me to do with this credit card? Oh, you can use the money to go and invest. Whoa, I tell you, the poor chap had an earful from me, because a lot of people do not realize 18% per annum, that's what they think they're paying. But actually, if you cannot pay your credit card loan and you roll over, I have done one for my client previously when I was a unit trust consultant. They actually, in the end, pay about 24% per annum. That's a huge sum of money. Not worth giving, not to say that we don't love the bank, but not worth giving to the bank when it doesn't benefit you. Whatever you put up must benefit you. So, to me is, if you want to take out a loan, you please remember to be very disciplined, pay it off, make sure, talk to either your UTC, your consultant, or your licensed financial planner. Make sure you have the capacity to pay, and that you are leveraging on it to take opportunity. But if you're just taking on it because someone is doing it and you have no way to pay, please say no. It will be the best decision you ever made for yourself. That's what I like to say.
Okay,
I'd like to just, sorry, I'd like to add
hang
on
on.
to what...
Hang on, there's a question here from the floor. Maybe Joyce, I'll throw this back to you later. But the question is very good. After 30 minutes, we now have a good landscape of how loan financing is and the various ones involved. Let's steer the conversation now towards loan for investment purposes, specifically for unit trust, and I suppose ASB and ASM as well, and for stocks. We know that housing loan, debt management perspective is actually quite okay, that we understand that bit, but loan specifically for investment, i.e. unit trust and stocks. Shall we zoom in on this now? Joyce, you wanted to add something?
No, I wanted to add to what Nirmala mentioned about taking out an EPF and then not repaying, and using it for some other to repay your loans. I think if you ever take out money from EPF to repay your loans, please consider that as a loan from yourself, because this is from your future self. EPF is for your future goals, which is for retirement. So you're just taking a loan from yourself. Please promise yourself to pay it back, including I Lestari, Sinar, and all that you have done. If you have done, that's what I wanted to ask. And since I'm, sorry.
Go on for that. Okay, so let me rephrase, because Linnet was also mentioning early on in her opening statement. Just now she was talking about taking a personal loan, but also include a takaful element to it, or an insurance element to it. A lot of my friends do take up loans, but they don't want to pay insurance or takaful. Many of them are happy, living well, but I'm very nervous about their investment or loan debt management because there's no takaful. So I mean, what do you expect, right? If the unforeseen circumstances happens, it's going to be doubly bad for everyone. The question now is, do you think that, say for instance, an ASB loan is the easiest for us to illustrate? A 3.4% loan for ASB 200,000, and ASB has been paying about 5%, but of course the number has been declining. I'm expecting next year's number, or this year's number, is going to decline even further, perhaps one of the lowest ever, but that's how it works, I suppose. Do you feel that these marginal differences of 0.6, right, 3.4 versus 4.0, assuming ASB pays out 4.0, is this worth it? That would be one of my questions. Who wants to take this? Joyce, would you like to take this?
From the cost-benefit equation perspective, anything that's in the money is worth it because it builds wealth, right? However, it comes, if you have a problem with managing your emotions or not having a discipline to repay, then it is not worth it, because you may end up poorer than building wealth of the additional 0.6. Now, the margin is not the issue. The issue is, 1, your discipline in repayment, 2, your liquidity, 3, your skill set. If you are using this money to invest in, say, not ASB, but in shares or even unit trusts or something like, I don't know, some other speculative investments, then your skill set has to be there. Now, I myself am, I'm here at the forum, and normally I speak to clients about their financial plans, and I may not have the time to look at what's happening to my stock right now, and if I just give it to my remisier or stockbroker to look at it, he may not have the time either to look at when should you just liquidate this and cash out. So your skill set has to be there. And 4th, you need to have the time. You need to have time to monitor these volatile investments. It's fine if you have these investments, this money from your loan for conservative, secure investments like ASB or a mortgage, but not volatile ones. You need to have skill sets, you need to have time. Plus, if you're using it for unit trusts, remember it is not just for one product. Build a good portfolio that's efficient, that gives you a good weighted average, estimated to be way above your cost of borrowing. That's where you are in the money, and that would make perfect sense. So these are some of my thoughts on the question.
Let's talk about volatility here, because share margin financing is also a big conversation. I just pulled up ringgitplus.com. Some banks are offering about the same rate. 50,000 ringgit, interest rate is 1.75, plus stamp duty 0.5% of financed amount. So let's say 2-point-something%, and then a few opening fees, account fees, and all this. All in all, we're looking at about 3%. Do you think that this is a smart idea to take a share margin financing at an interest rate of lebih kurang 3%, and then roll the dice, I suppose, and claim that we are the best mahaguru of share, or call this investing? Do you think that this is? I know Joyce has said something about that, but with a 3% interest rate, is this a smart idea?
Well, I have known of people, these are whom I call experienced traders. They have done that. To them is, out of 10 times that I trade, if I can make money 5-6 times more, and also the returns that I get from it is higher than what I would have to pay in terms of borrowing, on top of that I still make money, then it's worth it. However, if you look at what they do, okay, these people practically live, eat, breathe stocks. They have their charts. They have their, they check, they have to check what is happening around the world in relation to Malaysia. And then they also have to monitor. The only good thing about doing trading, share trading, is that nowadays the tool that you use is more sophisticated. You can actually fix when you are supposed to get out and when you need to take profits and when you need to cut loss. So that is a good thing compared to those days. However, the discipline, again, it comes back to yourself. What do you do with this money when you make it? Do you punt it some more, or do you take your gains and put some aside and use the rest to go back in again? So it's your attitude towards money and what you do, whether it will determine whether you're successful in loan financing for investment. That's my 2 cents worth.
Okay, we have two questions, but both of them have been answered on the panel. I'll just recap. First question is, what should we do before deciding to take this route for investing or take up loan investing? We have discussed this. Discipline is important. Taking a loan against yourself, for instance, if you borrow against CPF. Also, the ability for you to understand the interest rate and compounding interest rate, from you earning such investment, either unit trust or ASB or EPF, versus the kind of fixed rate like a housing loan with the 3% interest rate. You shouldn't, pay off your loan so early or take up something that could give you money, i.e. EPF, from paying off something that is not going to give you money, i.e. your housing loan. That's one item. Second question is it worth to get a loan up to 200,000 to invest in ASN, Amanah Saham Nasional, with an average return of 5% if I am able to pay monthly installment of a loan of 3.5%? Joyce has categorically answered this. Go for it because it's money in your hand. And of course, 3.5% is a stable fixed rate, or 5% is not the 5%. The ASN element is actually very safe, very stable. So, do it if you can. Which brings about another item here, which is to understand the risk involved when it comes to mutual trust, unit trust by taking up EPF. There's a lot of, I think many of us are familiar, or at least have heard about it. Boost your EPF savings and increase your purchasing power by taking up the members' investment scheme. There's a lot of mutual trust companies here. Is this a good idea, i.e. to take up some of your EPF money and plonk it into unit trust schemes? Yeah, anybody who wants to take this up?
Yeah, just on this EPF also, I would like to also add in that you need actually something about unit trust lah. I think everybody should be aware is we think that unit trust is a fixed return. We think that unit trust will definitely give us returns and it's high return. It's not so necessarily like that. You still have to understand where in unit trust it is invested. It's not fixed return, because I have a lot of people who have invested, because they know EPF have offered this scheme, and then so when I ask them what is the returns like, what are the returns you're getting, I don't know. I don't know whether how much, but I know there's something. That's a very wrong thing. I think that's something, because I have personally seen their statements and some of it was actually lower than what EPF was giving. So then you are not making money again. You are losing there. Of course, dollar cost averaging, you have long-term things, you've got to see, but you've got to also weigh in, you've got to review your portfolio every yearly. You've got to review and decide, then you decide. So this is where I always tell clients is when you want to make unit trust, you want to do unit trust investment, don't take things for granted. It is not, you do not take things for granted here, any kind of investment. It's just not for the sake, hey, I've invested. But it's more of like, I have to put a target. You have to put your own target. Okay, by this age, I want to make this much of money by 1 year. So what are the plans I should do? So that's where you talk to your planner, your unit trust agent. You say, what is the portfolio I should go in if I'm looking at this kind of return? What my monthly, how much should I put, and things like that. And every year review that back with them in terms of like, okay, where am I now? Should there be a switch? Should there be a this thing? you go with that. Even if it's from EPF, don't take it for granted, because you know if you leave it there, they're still earning, and you don't want to lose out of that by going into something that's going to pay you lower. So whether it's really good, whether it's really bad, we cannot say upfront, oh, it's good, or go in. But it's good, you must know what you're investing in, where you're investing in, whether it's going to give you higher returns. So you want to make the most out of wherever that's going to give you highest. So that's where. But of course, you calculate the risk. We calculate that risk here. So that's something that we fail to do, is reviewing, I think, in this part. But I also want to add in another thing, Ibrahim, that talking about, we had all the earlier questions about going into investing, taking up loan financing. So there's one more part that's very, very crucial, is before you start doing loan financing, the education is very important. Linnet has clearly mentioned that these people are seasonal traders, so they know. You don't go in a new kid on the block and then you straight away want to do it. That's a big danger. Okay, and another most important factor is, before you do this, make sure you have emergency buffer with you. That's very important. That is very important. Before you take up big loans to go there, you have an emergency buffer fund, cash, or saved up somewhere that will help you during emergency times, because times are uncertain. We saw this during COVID. Is a lesson to us. Actually, the recent pandemic is a real lesson to all of us that nothing is permanent in life. You can be, flying high with a permanent job, high salary and things like that, and the COVID hit the industry and they're back on ground. We saw especially the airline industry. So these people had actually invested here and there, but they did not have cash backup money, and they also financed big things, like big properties, because you were earning big, but when times hit bad, there was no cash, there was no backup savings or things like that to actually help during emergency times or illness or things like that. This will also kill your investment plans, your thing plans. So this is the ground. We say this is the foundation, is to have your emergency buffer fund for at least, I'm not sure financial planners will say 3 to 6 months of your living expenses, but at least to the more, because statistics have shown that 70% can't even raise 1,000 ringgit during emergency period. They can't even raise out that much of cash. So in planning to grow your wealth is extremely good, but at the same time, do build at least about 3 months of your expenses that you can cover in case something were to happen. So you have this emergency buffer fund. So I'm sure Linnet and Joyce would add on to more where they can keep this emergency buffer fund instead. So that also generates for you some money, but it's also, there's all about playing, diversifying. You diversify from here to here. So you want to finance, you want to use your EPF, the unit trust, is all good, but you also need to review your unit trust returns. Don't take things for granted because this is the mindset. And a lot of times, many investors do not understand the statement. So they fail to see what is the actual return, and they fail to know. So this is where your agent, your planner, your financial assistant comes in and asks. I think asking is another thing. We always feel that if I ask, they think that I'm stupid, or I do not know, or I'm ignorant, I'm this thing. So we feel shy to ask also, actually. But if you ask me, this is our hard-earned money. Ask the most serious, the simplest question, it's okay. But at least you understand to what you're doing. Yeah, that's what I would like to share, Ibrahim.
Joyce or Linnet, you want to add on to the EPF versus unit trust, or
Yes.
taking up EPF? Yeah, go ahead.
Yeah, I think EPF opened this up in 1997, I believe, way back in 1997 for a good reason, so that EPF members can take responsibility over their wealth and invest it prudently with guidance. Unfortunately, over the years, emotions have run high, and possibly investors were not properly educated on building a proper unit trust portfolio. Rather, they have been chasing after returns or product returns. They look at Lipper rankings or historical returns and assume that will continue on. So what will, from an investment angle, what will smoothen out these unexpected events like COVID? I'm not sure how many of you will be panicked. And if you have a good portfolio that you rebalance every year, and that's tied to a purpose, which is retirement, there should not be a real panic. Of course, we're still human beings, so that's one thing to add on. The other thing is to know, as Mala said, what you are investing in, what are your returns. But besides that, you need to know what are your underlying assets in the unit trust funds. It's not just relying on your unit trust agent or financial planner. You as an investor, you have to take the other part of your responsibility to know not just the CAGR or the compounded annualized return, as well. You need to also know your underlying funds and what are the underlying assets and investments and countries that you're in, and not be surprised that suddenly your money is in somewhere where you're not even sure. I think third, back on Nimala's point on rate of return, it's important to note that as an investor, there is a difference between compounded annualized growth rate, CAGR, and simple annualized returns. Unfortunately, a lot of plans that, not plans, a lot of reports that I see on unit trust funds that come to me on my table, I see that the returns over the years have been annualized on a simple annualized basis. And you can't compare that with EPF because there is a difference. So the education wise is not there. I think, and I think last but not least is that I see also a lot of movements during volatile period and peak periods. Peak market periods where you take profit as if you're a trader and you switched out and switched in, and there's too much movement. Now, from a research that's done by Dalba, they found that average unit trust investor has underperformed even the S&P over even 20-30 years on a CAGR basis. Why? Because they have reacted to market movements or done too much movement in their portfolio, making it not efficiently giving you a good efficient return. I mean, let's just take an analogy. If you're baking a cake, every now and then you just open the oven door and say, is it baked? Is it baked? And you're just letting in air in. It will not bake. You will not have a good cake baked after some time. You need to let it bake, but through thick and thin. But how do you smoothen out volatilities? So you need to have a good portfolio. Don't chase after products. Have a good portfolio. Have a good guide. And the guide is not just to tell you which are the best returns. The guide, in this sense, a financial planner or your unit trust consultant, is an emotional guide. It's there to say, hey, look, let's look at the mountains and not look down on the valley when, like COVID, you look down on the valley, you just be scared. So, and keep focused on your goals. Why did you even set up? Why did you even take out money from EPF in the first place? Question that. Is like your relationship with your money, right? Or your relationship with your spouse. If something happens, you need to ask, why did I come into this relationship? So those are very pertinent questions to ask.
Yeah, I read somewhere that 9 out of 10 times why spouses fight is because of money. 1 in 10 is because of other reasons. So imagine all the other reasons. This include, third party in the relationship and all that. All that is a fraction of that 1 in 10. So that's 9 out of 10 is a big deal in terms of why spouses fight. But we have a question here. Not much of a question, just an affirmation of how this person invests. I use investment loan repayments as an alternative to dollar cost averaging. All right, so this guy takes, or this lady takes a big loan, a big chunk, plonk it in. And this person asks, starting with a higher principal should give better returns. What do you think of my approach? I like this question because I myself am grappling with this, right? Do we go with a dollar average, averaging, 100 ringgit for 20 years, every month for 20 years, or big chunk, plonk it up, and then pay the loan, and then hopefully the principal grows. This is a strategy, of course. Anybody wants to take this up?
Well, I'll say something again, Ibrahim, if you don't mind. The fact is that if you do a big chunk, then it is just value averaging versus dollar cost averaging. Dollar cost averaging is no brainer. It's just at every interval, fixed interval, right? Fixed amount. Whereas value averaging is when you see there's market dynamics and opportunities and you put it in. So it is to me it's important that you have to be very certain what you're investing in. If it's ASB, yes, big chunk for by all means. But I was going to say that if you're putting into a share, you got to be really familiar with the share and be ready to a dollar average, because anything that's volatile, you need to have ready funds to dollar average. So that's my thoughts on it. It's quick and fast.
Yeah, just to add on, I've known someone who put in a chunk of money during in March 2020. And what happened was they put in investment stocks and they made money, very happy, but didn't get out. And then the market went down and they lost money. So you must have the knowledge. I think that's very important. And the other thing is also two things I want to talk about. Number one, what are you investing in? Because Namala has very rightly pointed, most of the people in financial difficulty is because they went into scams. They thought it was investment. So be wary of people who come and tell you that I'm offering you this investment. You can even take your credit card or your loans to invest. The reason why you don't see it registered with SE is because it's very costly to go through all the process. Therefore, we are giving the money into your pocket, the profits. Never happens, okay? It never happens if it's a scam. So be wary of that. Second thing, when you engage either a financial planner or a unit trust consultant, you must also pay attention and take ownership of what you invest in. To deep dive into what Namala said about asking questions, I have seen unit trust consultants who put their clients' EPF money. The client has got 2 years to retirement, but put all the investment into one small cap fund, all of it. And unfortunately for that agent, the market dropped. And we all know that during a down market, the small cap funds are the ones to really deep dive in. So the agent got caught, the client got caught. So as a investor, you must take an interest in what you're investing in. Don't say you don't know. Because at the end of the day, you must remember, you sign on the dotted line. Henceforth, you are responsible for whatever decisions that's made. So don't leave it to someone else, but at least take an interest and know what you're investing. If you need more time, please take more time. If you need to ask questions, please ask questions. Okay, and I know there might be some unit trust consultants in there. Please take good care of your clients. If you want to take their money for retirement, make sure you do proper asset allocation. You have different funds to choose from. Don't punt all into one for your client. They are dependent on you. So love your clients, love yourself. That's my sharing. Thank you.
I'm going to ask something that might not be too popular amongst our consultants watching us right now, which is ETFs. As we all know, ETF and unit trust both offer diversified exposure to the market, but there would be some very important fundamental differences between the two. And while EPF has allowed for member investment scheme to be used for unit trusts, the conversation is still ongoing whether or not we can use EPF for ETF. And I know none of us represent EPF right here, but what would be some of the thinking that needs to go when it comes to taking up loan financing for ETF? And I mean no disrespect whatsoever to the unit trust consultants out there, but it is something that I guess the public must think about as well. Any thoughts from my illustrious panel this morning?
Okay, I'll take that one again. To start off with, exchange traded funds. Exchange traded funds have definitely I mean, there are many types of exchange-traded funds, ETFs, and you need to know what these ETFs are investing into. What are the underlying assets? Again, it's just like structured deposits, right? It's like, if you've heard of structured deposits from the bank, they seem conservative enough because they give you higher rates of return, but what are the underlying assets in those kind of instruments? The same with ETFs. So ETFs normally will hug an index, or you can have ETFs in other sorts of instruments. You need to check it out. So whether we should allow, what are my views? We should allow EPF to withdraw EPF for ETFs. I think it's probably a bit premature, because it really does require a good guide or a good skill set, I've always mentioned, to look at ETFs. Now, having said that, there are also funds that invest in ETFs as well. If you're not familiar with it, there are funds, overseas funds, that you can capitalize on because they invest in ETFs. So there's nothing wrong to invest in a fund that invests in ETFs, and it actually saves you the trouble from having to monitor that instrument, which is the ETF. Now, ETF can make money, but it also can you can also have more volatility than a diversified fund of underlying investments. Those are my thoughts.
Joyce, do you think that it's smart to go into both then?
Gold. I'm not.
No, both.
Both. I heard gold.
Diversified in ETF and unit trust.
I see. Right. Yes. So, in from an investment portfolio perspective, right, there are what I call your core investments and also your complementary investments. So, your core investments would be the ones that are like your ASB, the ones your real property, your investment properties, as well as your unit trust funds, which are very much diversified and very not country specific, like going into Middle East kind of one country specific kind of investment. So yes, those are core. So yes, my long answer to your question is yes, because ETFs can form part of your complement. Then these are sweeteners that can increase your wealth, but it can also go the other way around. So it's a two-way street. Yes, my answer is definitely yes, with skill sets and guidance from someone.
I think I wanna. This is very timely for me to ask a question from the public right now by anonymous. And the spirit of the question, the phrasing of the question is, I've been rereading it again and again. I think I'm trying to capture the spirit here. This is a person who has a stable salary from a Fortune 500 employer. This person has found landed property and take loan at 52. I'm not too sure what at 52 is. Is it his age or her age? Is it I'm not too sure, but it says found landed property and take loan at 52. So now the question is, should I sell off my condo to reduce my loan liability, or invest in unit trust for growth under 60? I think, like I said, this question, the spirit of this question is more of, should I reduce my debt liability or pay or invest in unit trust? I don't know whether this makes a lot of sense, but that's the question that was asked.
I'm going to pass this question because it's a personal question and I'm not licensed to answer it. So Joyce, I lob it over to you.
Only licensed person here.
Yeah, I'm certified, but I'm not licensed, so I don't practice. I cannot practice, so I'll pass it over to Joyce.
Thank you, Linnet. Well, whether or not you should clear your loans is really very dependent on your own financial situation. I mean, a person is 52 and we live long lives, right? And our retirement age is 60, so you still have 8 more years of good earning income. I mean, is the person still earning an income? Yes, right, from a Fortune 500 company. So and how do you magnify those income? I will use the word magnify. Is that yes, magnifying is through leveraging, and leveraging is through capitalizing on good loans, good debts. So a mortgage is a good debt, and so long as the interest rate environment remains attractive like now, then yes, you should use it to invest in a portfolio of unit trusts, not in one single product. And please make sure you do your due diligence, having the right buddy, a financial buddy, to just nudge you or to just guide you and understand all those things I've said just now about unit trust portfolio. Not too much movements. Understand what is KEGA, not a simple annualized return. Know your objectives. Know what are the underlying assets. Don't chase after returns. Don't panic. Keep your emotions in check. I mean, so many things. So therefore, sometimes, you know, it's like going to Russia and you don't speak the language, so you need a tour guide. Similarly, if you're not good with your wealth building skill sets, then you need a guide, a good guide, to guide you. So back to the question, yes, you should, with care, capitalize on the low interest environment and magnify your earning power, which you're still, I suppose you're earning a good salary from a Fortune 500 company, and watch your portfolio carefully. Now, about watching your portfolio carefully, sometimes we overwatch our portfolios, our unit trust portfolio. What I mean is that you look at it every day, or you look at it every other week, or even every other month, and that spooks you, you know, because the markets are not, they do not travel in a straight line, and then you being a human, you will tend to react to it. So I've often said, with regards to your investments and the volatile nature of your investments, do not react, but respond. Okay, respond in the sense that, should I dollar average? Now, it's easy on the, you know, academic wise, or, you know, just you know, in a forum, say let's dollar average, but to do it's really hard, because when do you dollar average your unit trust portfolio? When it's down by what, -10, -15, and I remember dollar averaging my own unit trust portfolio during the great financial crisis in 2008, over 4 times. The first three times after averaging, I kept losing even more money. It's like, then I should not have done it, isn't it? I should have waited for the lowest, but who knows when is the lowest time to dollar average, you know? So I had a strategy, a dollar average over 4 or 5 times. That was in 2007. I kept losing money every time I checked it, so that was bad. It spooked me. Then I decided that I'm just going to keep to my purpose of why I had that portfolio. Today, that portfolio is about 3 times to 4 times more than what I had put in after 12 years. So there you go. You know, those important investment concepts have got to be in if you're doing that. Ibrahim.
Let's go back to Nirmala. Could you share with us some of the stories that you had to deal with at AKPK when it comes to the inability for an individual to service debts? What would be some of the bigger problems of people resulting in them having to seek assistance at AKPK? Is it more of them losing their jobs, or is it the lack of discipline, or a combination of either? More of that.
I think it's a lot. It's a combination, but what do we normally see is actually emotion-related thing in terms of discipline. So you started off right, you had right goals, you wanted to do things right, you had the thing, but down the road you got excited, you probably, you know, miscalculated things, and so it happens when something that, okay, you have a plan, you draw up a very nice plan in terms of, okay, I'm going to invest every month this amount, I've taken up this financing, this is what I want to do. But as I mentioned, life does not go as planned always. We've got to accept this fact. There will always be things that we do not plan happen. You know? So this is when this is what, you know, a small thing, a small other expenses, a small other misfortune happen, they are stuck already with their finances. So that's how I see most of the clients who come to it. It's not that I deliberately planned myself and, you know, it's more of like, I did not calculate my risk here in any terms, and, you know, so I don't have that backup savings for medical, I don't have good protection plans for medical, I didn't even understand my protection plans actually to know even what they cover, you know, so there's a lot. So then it comes back to lack of awareness, lack of knowledge, you know, I did not know what I was getting myself into. So for example, you were talking about rates, right? Interest rates. There's another thing when I take up personal financing, I need to know what's my effective rate, not the rate that's published. There's a difference there. And at times they come back to me, I've been paying and paying and paying, but I don't see the amount reducing at all. I don't see the principal reducing at all. I've paid almost this much of years. So people are puzzled why it happened, but they were unaware of, okay, how the calculation went on, what is the actual rate that was calculated. They advertise to you 3%, 4%, but what's the effective rate? It's double than that, it's higher than that amount. So it's actually a higher cost there involved, So if we look at, I would say, to me personally, I would tell you personal financing is a killer. Personal loan is a killer. It is a killer. I'm not talking about the personal financings that we take for ASBN because that's a reducing balance rate. That's different. This is on the flat rate concept where, you take personal loans. In fact, I've seen people who took personal loans to renovate their properties, to pay up the down payment for their properties. That's a killer. That's a killer because it's on a flat rate. We've got to understand the flat rate where, you upfront, you calculate just like you buy a higher purchase, so it's higher. And if you look at bankruptcy stats now, the number one reason for bankruptcy is personal financing, personal loan, and followed by higher purchase. No longer credit card has never been there. Okay, it's always less than 10%. So the highest is now personal loan, personal financing. It's because people took huge sums, 200 over 1,000. Right, at a rate of, they thought it was 3%, if I were to calculate. And over a long tenure, the problem it was a long tenure. Initially, they were given 20 years. So now it's like about 10 years. They brought it down to 10 years, but still it's long. Okay, so if we were to calculate, they almost be paying, if I were to take 20 years with a 3%, 100,000, I'm actually going to pay back 160,000 there, in terms of the rate. So people were not aware of what kind of loans, what are the rates. Okay, if I were to take a loan of this to finance my investment, I have to ensure I'm going to earn more than that. So I need to know what is the actual rate here. So this also many did not know into what. So this is what I see. In fact, we were chatting yesterday too. I had a client who actually refinanced his property to go into more investments. And ended up, all those investments he did not know. He was just following. We call this not the right gurus lah. There are many out there, so we have to be very, very careful here. And he did not know. So the key thing is I need to know, not just follow anybody. Doesn't mean he made money, I will make money also. It does not mean that. Okay, we got to throw away all these things. If he made money, I'm also going to make money. I don't want to miss the boat. I want to jump in there. It's okay. Go slow and steady wins the race here. I agree with Joyce earlier. You don't have to be like haywire when you hear a panic news. Oh, what do I do? I totally agree with Joyce here. Like I have to calculate that. So that's what we see. And I've also seen cases like I mentioned earlier where they took up this financing into a lot of properties. They went into the property market. Was good those days, those days. I'm not trying to say anything or speculate anything, but we know that the current state of things, we have more properties than the demand. Supply is more than demand. That's a fact. Okay, so we've got to be very careful in terms of our interest, rental yield, the returns that we're going to take, whether it's going to be sufficient enough to pay back your loan, because many of them went into that. Either they want to, buy and sell immediately, when things are good, or they were buying for long term and then depending on rental, so there's also risk things here. So I had these guys who, they quickly go in and buy properties when, the market says, okay, this is where the university is coming out. You've got to buy your properties here. There'll be students renting out, and I think this happened somewhere in Bangi. Bangi near UK, and there's supposed to be this college or university up next to that. And then they advertise on this student colleges. So people bought units for like about 35,000, 36,000 per unit. So people bought many, okay, at that point of time, because Bangi is next to UKM, right? And then you had the German Institute there and all this. So you never expect that this would go abandoned, and the project went abandoned. And people who bought the projects were like, they bought few units, and when they came to us, it stuck. It stuck like about 100 over 1,000, 200. You got no choice. The bank has paid for you. There's no argument when it comes to abandoned project. Okay, it's between, if you want to claim the money back, it's through the developer. Okay, but for the bank, I financed your project, so you still got to pay me, right? So they ended up paying these loans. Yeah, of course we worked it out, but it's sad lah. You're paying for something that you can't even go and stay in. If you go and look at the area, you can't even. So there are a lot of investments like this that has gone abandoned, has not what it was predicted. I'm sure we all heard about a few areas that was projected so much, like they say airport was going. I don't want to mention places, but airport was supposed to be there many years ago, and things all change. So we've got to be very careful here, because especially when it comes to, I've seen a lot of cases, especially when it comes to property, because it's a huge sum. It's really a huge sum. Yeah, we are committed to. Yeah.
Just to jump in, even if you have property investment in areas where there are a lot of universities, Section 17 is one of them. There were so many universities. There was Utah, and other Islamic U and all that, but they moved. So the people who invested and made money in the past, now they are stuck, especially during this pandemic, because before the pandemic, the universities move around. So just like any other investments, you need to put your ears to the ground also. I'm just adding on to what you said about property investment.
Yeah.
Nothing is permanent.
I totally agree. And especially when we give up for rental, we got to be very careful. There's a lot of risk that we got to weigh here. I've seen worse cases, Linnet. I've seen a tenant who was so angry that the owner was asking for rental. They destroyed the whole house when they were chased out to the max. They actually removed the roof. They took time to remove the roof, just in terms of like anger. Can you imagine? This is like what you call tenants from hell, I guess. But I've seen there was a client of mine, and it was so sad to see her, a single mom, trying to work, to work out things through, she had one property where she was like renting out, and things fall like this. So I'm not going to scare people. Please don't take it like, because coming from AKPK, we hear all these stories, but it's all about you being more careful, calculating your risk, have a good guide, and going, because
do your due diligence.
Yeah, do your due diligence, because the way to grow your wealth is definitely investments. So yeah.
Yeah, I'd like to just jump in on that particular issue about rental. The fact is that often I ask my financial planning clients, when you want to get a rental property for income, which all of us, like, is that, are you prepared to be a landlord? Just as Namala said, are you prepared? Because you meet all kinds of people. That's one. Are you prepared to be a landlord of a residential property or a commercial? For me, I'd rather be a landlord of a commercial property, because I don't have to be worried about the curtains and there's leakages and all that. You just rent them empty and you get it. I think the second thing is about rental yields. Unfortunately, the rental yields from a financial planning perspective have not been calculated. It's been incorrectly calculated. Now, from the many analysis I've done, rental yields, if it's like 4-5% net of your costs, which includes not just your taxes, it includes your running costs of owning a property. There's so much, right? Assessments and what have you, repairs, and interest. There's a big chunk. After taking all that into account, your net rental yield, if you're getting 4 or 5%, that's considered very, very good. So please be very sure how rental yields are calculated. And I think thirdly, with regards to property investment, don't over asset allocate. Just like what Namala said, I've known someone or a few people who had got into this investment guru kind of club, and one person actually committed suicide because he over allocated and became a bankrupt, and he actually jumped to his death. And that has cost lives. And I often joke that the duty of the financial planner, or the role of the financial planner, is not to make you rich, is to prevent you from being poor. And I think in this case, to prevent you from losing your life if you're over asset allocated into properties.
Which brings about this question from the public here, again by another anonymous. Apart from investors being ignorant, shouldn't there be accountability put on UTMC or Unit Trust Management Company or UTC, Unit Trust Consultants, who aggressively market unit trust as somewhat profitable, assuring good returns? Basically, the spirit of this question is more of, is the responsibility solely on the investor, or should it be shared across the parties involved? That is, I think, that is the point of this question.
I'd like to pick up this question because coming from Financial Planning Association, some of our members are not necessarily financial planners. They could be tied agents, regardless of whether they're from the insurance or the unit trust part. But I would think that there are guidelines for best practices, and you need to do consultative selling instead of doing product selling. If you really want to keep your clients and keep your clients for long term, and I think that to a large extent, the consultants have to be accountable. Accountable from which angle? Accountable from looking at your client's situation and recommending the right funds for them, as well as how you're going to build the portfolio. Do not put in the hottest fund just because of past performance. You're not doing justice to your client, and when you don't do justice to your client, you don't do justice to yourself. Because at the end of the day, you only have this client for this time period only. Whereas if you do right by your client, you keep your client for a longer term. So take good care of your client, but from their angle, because you must know what is the risk that they can take. And I think it's not just only the agents or the investors. I think there needs to be teamwork. So like I said earlier, the investor, yes, they must take note and be careful. Don't always think that, I leave it to the agent, and at the end of the day, if anything goes wrong, I blame the agent. You can't do that. But on the side of the agent, you must also make sure that you do your due diligence and do the best you can for your client. And always tell the good, the bad, and the ugly. Don't just tell the rosy story, and don't tell the downside. Because when your clients are more prepared for whatever pitfalls that may happen, they understand and they're prepared for it. They will appreciate when it comes. They will know what to do. So I think it is both sides. It's not just one party that has to take the full responsibility. I hope that answers the question.
Well, in a way, it answers it. But I was working in a bank about 5 or 6 years ago, and it's a universal bank. It has all the other services, everything there. I visited an asset management subsidiary of the bank, and the asset manager there had a big thing on her office: past performance not indicative of future performance. It's so huge, it's unmistakable. So I was asking her, what is going on with that, right? I mean, it's like, it's not the greetings or word of God or what, but that thing. And she says that she's trying to scare her clients. She has all the prospectus, she has all the brochures, but that saying she says on the wall is not a reminder for the client, it's also a reminder for her. That is one crazy story here that I've heard. We also heard about the conversation of how to talk about interest rates and stuff like that. There's another question here. It might be a little bit off tangent, but I'll still ask you anyway. We still have about 10 minutes left. With the interest rate being low now, can a customer visit the bank and renegotiate a housing interest loan that was agreed upon many years back, assuming that it uses a flexi loan? I think this is more of a personal troubleshoot question. I don't know whether any panelists want to take this up. If not, then we'll move on to the final topic of the day. All right, so we move on to the final topic of the day. We want to talk about some of the key points of the panel discussion, loan financing, some key tips that you might want to share. I know we've heard a little bit about good debts, bad debts. We heard a little bit more about 3Ps from Nirmala. We've also heard about the element of insurance or protecting your loan financing with an element of insurance or takaful. Those are the key points. But strategy-wise, moving forward, we now know that the world is still grappling with COVID-19, but in a different form. Less people are dying across the globe, but people are still dying, right? Many of us are probably being afflicted with COVID-19 or any other diseases, but we're not literally dying from, many of us at least, and we're still protected because most of us, if not all of us, have been double vaccinated, including my youngest daughter, actually, quite happy, actually, we did it over the weekend. The story now is, what is the strategy moving forward? Perhaps personal stories, tips and tricks. Maybe Linnet, you can go first.
Well, I have shared my personal stories, but I've got a few keywords to as a takeaway. Number one, and this is for investors, be very clear what is your goal. Make sure you have your protection in place. Also have your emergency fund in place, and do your due diligence before you borrow any money, and be very sure that your investment is genuine. This is my takeaway. Thank you.
Thank you, Linnet. Joyce?
Okay, for anyone, I mean, all of us manage our own money. We have our money, and you don't have to go to a financial planner to get help unless you want to. Now, the first thing to do is please inventorize your financial life. The funny thing is, I would say 98% of the time, from my client meetings, they do not know what they have. They have not inventorized. They don't know what are. Yeah, they know the big ticket items, but they have sometimes left out some assets and sometimes some liabilities. So know your financial life like you want to know someone really well, because when you know your money well and you have a relationship with your money, it will reward you. If you don't know your relationship, if you don't have a relationship with your money, you may be penalized for it. So inventorize. Any company or any retail shop will close a day to do stock take. So my advice is close a day, find a day every year, do a stock take of your financial life, and check out what is the health of your financial life, just like your physical health. And if there are gaps or problems or bad debts, or you have not taken even a single debt. Now, if you have not taken a single debt, having said that, it may not be good because you don't have a historical record on secrets and how is your payment history like. So have you been too liquid that you have not even capitalized on any debts? So all those questions are important. Do that once a year, and know where you're going in terms of your goals. And just as we say, don't follow another person because they're not going to the same direction as you, right? Your journey is different from the other person. So don't do a copycat financial planning kind of thing. Do it on your own every year. Inventorize.
Okay. That is, of course, my biggest takeaway from this panel discussion. Inventorize my financial life. I have it in my head. I didn't put anything on paper. And unless my wife knows how to access probably she does, I suppose. She can probably track most of my stuff, but it's better to put everything down, I suppose. It's also a good stock take. When I was young, I did a stock take. That's when all the pilfering happens, by the way, the stock take event. Tapi tak apalah, tu dosa lama, I Form 5. Let's move on to Nirmala for the closing statements.
Thank you. I'll just add on to what Linnet and Joyce have actually mentioned it very clearly, but I would just come in from where we are from. It's like if you have debt issues, if you have taken, and if you're in trouble, please do not be silent about it. From the 3 P's, I'm just moving to the 4 A's actually. Acknowledge there is an issue. If there is an issue, acknowledge your finances actually. Acknowledge where is it at the moment. It's okay to be wrong. It's okay to be make some mistakes. It's okay, but as long as we know we want to change, we want to change and we want to make it better. Analyze your situation. The second A would be analyze. Analyze the amount of debts you have. Analyze the amount of your cash flow. Analyze them. What's your in? What's your out? What's your actual spending? So analyze them, and just don't analyze and then keep quiet. And analyzing this, you have to write it down, Ibrahim, not just thinking of it Yes.
Tengok aja.
Yeah, no, you got to write it down. Okay, because until and when you write down, you don't really know. Yeah, so then you know what to act on. So then you act. So okay, who do you see? Do you see your financer? How do you reduce it? If you look at your cash flow, sometimes when you write down, you'll be really surprised of what you see, in your actual cash flow. So what do I do? Do I have to reduce? If I have to reduce, if you're in a family, please talk as in a family. Like you mentioned, Ibrahim. One of the main reason of divorce cases, I'm not saying the only reason, but this is one of the main reason in finances, is because we don't communicate. And whenever it comes to reducing finance, we always blame the other party. We say it's because of them, that's why it's high. So, and then when we actually write, and then we have to sit in a family and actually discuss, okay, where do we reduce? If we reduce this, what's the impact that's going to happen? What's the impact to the child and things like that? So act upon it, yeah. And then if you can't settle your own debt issues with yourself, the fourth A is coming to AKPK. We are here to help you. Remember, we are free of charge. We do not charge. Yeah, if you have high debt issues, do come to us. We'll be able to talk to the financer on your behalf. And so it's just about acting on your finances. I think that's the key thing, is acknowledging, acting, analyzing. Like I agree with Joyce, do a stock take. Yeah, a yearly stock trick is very, very important with our finances. It can possibly, you have to know, I think in financial management, to make it simple, you got to know where every ringgit you have goes to. You need to know that, once you know where your money is going. And of course, we also want to close it up is also giving back. So you earn, you manage, you save, and you give back. So whether you give back to the community in the way of helping each other, and also in a way of with knowledge, with things that you know, and or even with things that you can help with, I think that's how it makes us grow at the end.
I think that's very good timely advice. I think communication is key. At least with me, the problem my wife has with me is that I communicate too much for her. She's glad that I'm getting paid every now and then for talking. But I'm also big, you're talking about, tenant from hell. I'm a tenant from hell. My landlady is my mother-in-law. So I'm giving her hell. So it's not about the property. It's about me telling her about a bunch of stuff. But jokes aside, it's actually quite important for us to really use this opportunity to think about how we manage our financial life. Of course, this has been a very interesting panel conversation. And the big takeaways, if I can just summarize very quickly, the 4 A's: acknowledge, analyze situation, act upon it, and of course, AKPK. Joyce was talking about inventorize your life. And earlier on, Joyce was also talking about value cost averaging versus dollar cost averaging. And of course, Nimala did talk about purpose, payment ability, and payment records, and productive loans versus unproductive loans. And Linnet keeps on delineating the conversation of how responsibility must be shared. Full transparency has to take place. Continuously ask questions. That's extremely crucial. Sometimes consultants can be they just assume that the investor knows what's going on. And the onus is on the investor to raise your hand and say, I don't understand this jargon. It may be understood by 1 million people, but I'm not that. So continuously ask questions. The onus is on you to ask questions. You have to acknowledge, I was, prior to the pandemic, I took a scuba diving lesson. And the instructor's like, I don't know if you have any trouble. We are underwater, both of us. You got a signal to me, because you can't, I can't see what you're doing is right or wrong. You have to tell me what's wrong, right? So the first few lessons is always about communication, non-verbal communication, at least when you learn about scuba diving. But the moral of the story is you got to let other people know your problem. You got to let other people know what you understand and what you don't understand. Failure of which I think is very impossible for us to actually understand how to move forward together as one and build wealth together. It's a tough time. Everybody needs to build wealth together. And of course, that is extremely crucial for us to do it in the most informed way. I hope I have summarized this panel quite succinctly. Thank you very much to Linnet Lee, Nimala Subramaniam, as well as Joyce Chuah. This is a fantastic panel. I've always enjoyed moderating a womanel instead of a manel. Every so often I get accused of sitting in a manel, and I'm very happy that the organizers have put together a very, very strong set of speakers. Thank you very much for this. we'll go for the big item right now, which is the Investor Education Series Lucky Draw. 2 winners will win an iPad each. That will happen right now. And of course, a URL link to the quiz will be shared with eligible participants. And of course, for now, we say goodbye to our panelists. And I'll pass this over to Hannah, my colleague, who will be presiding over the quiz section. Thank you very much. Have a good afternoon.